Financial daddy and investment life bring you freedom of financial.
Hello everyone. Today, the Nasdaq Composite Index dropped by 0.67%. During the session, it opened higher but then fell. This happened ahead of Federal Reserve Chairman Powell's speech. The index continued to slowly recover the losses from the opening. During the speech, it gradually climbed, but around 3:30 p.m. Before the market closed, it suddenly plunged sharply. Overall, there are still significant concerns in the market regarding the index. But today, the Dow Jones Industrial Average rose by 0.4%, showing an increase in momentum. What I want to discuss today is, why is the market filled with concerns about a recession, and yet many media outlets and analysts are predicting that a recession is imminent, but so far, the United States has not yet entered a recession, and the stock market remains at a high level. According to the traditional yield curve theory, if the yield on long-term bonds is lower than that of short-term bonds, that is, if an inversion occurs, then within about 2 years from that point, a recession is expected to happen. But this yield curve inversion started in mid-2022 and has already lasted for 3 years. But the recession still hasn't happened yet. At least there are no signs of a recession in the stock market so far. In fact, as of October 14, 2025, the yield spread between the US 10-year and 2-year Treasury bonds is 0.53%. As for the yield curve, the fact that it has become flatter has further eased some of the pressure. The key question is, what about the current US stock market? The main thing is that the overall market is being propped up by the 10 to 20 largest heavyweight stocks, these giants. Other companies may have already started to see declining profits, but these big companies, they're still experiencing strong growth. For example, Nvidia's GPU chips are in short supply. Now, for its 2025 fiscal year, its revenue reached $130.5 billion with an annual growth rate of 114%. And what about Amazon and Google? Companies like Amazon and Google are also making major investments in the AI field. In 2025, Amazon's capital expenditure is expected to reach $100 billion, mainly for AWS services, while Google's will reach $82.2 billion. Altogether, the total investment by these major tech companies will amount to $364 billion. Despite these massive expenditures, the debt levels of these companies remain stable. There is no obvious financial pressure. The only potential debt concern might be Microsoft, because it is raising funds for building AI data centers through issuing bonds. However, as for these new data centers, whether their future revenues will be enough to balance out the debt and income is still unknown. In comparison, Google, on the other hand, what about our company? Well, their balance sheets are actually quite healthy. However, not all companies are so fortunate. Some small and medium-sized companies may already be facing bankruptcy, like the taxi company Hershey, for example. They are currently facing a severe liquidity crisis. In the first quarter of 2025, they reported a loss of $443 million, with their debt burden reaching $18 billion. On top of that, they're also facing lawsuits in multiple states due to a data breach. Starbucks has also encountered similar problems, just like in 2025, with an estimated drop of nearly 10 to 15%. Due to economic factors and intense competition from many strong competitors, a lot of their stores have already closed down, and the overall challenges are too great to be resolved quickly. In other words, the challenges are just too big and difficult to solve. In addition, some small banks are also facing the risk of closure, mainly due to the impact of high interest rates and loan defaults. Some institutions have already entered the regulatory stress testing phase. Because a small number of large companies dominate the stock market, it's difficult for the market to drop significantly. However, the index is extremely unbalanced in its distribution. The top 10 companies, including Microsoft, Apple, and others, now account for almost 40% of the weight in the S&P index, reaching 38.78%. This is a record high. These markets are being propped up by them, which is why they remain at such high levels. But in the future, whether the market can continue to rise will depend on the actual performance and financial results of these major companies. So even if you think that the current political events are just noise, the revenue figures in the financial reports will directly impact the stock market's movements. If these giants start to decline, that could become a turning point for a recession. Another concern is that most participants in the US stock market are retail investors and they lack much organization. So if the market crashes, it could trigger a domino effect that keeps going downward. As for the US economy, it's actually supported by a small group of wealthy people. If the stock market drops sharply and their income decreases, they'll buy fewer luxury goods and travel less, which will also drag down the economy and create a vicious cycle. The flow of funds in this regard is something we need to pay attention to as well. A large portion of the funds in the US stock market actually comes from foreign investment. If a global recession occurs, it's hard to avoid these funds being forced to withdraw from the US. So to determine whether the US can truly avoid a recession, we need to closely watch the financial reports of major companies in the coming months, or even the ones at the end of the month. Everyone should pay close attention to these. Pay attention, for example, to whether Nvidia can continue to achieve strong revenue growth in the second quarter. If they can't maintain such strong and sustained revenue growth, then market confidence might weaken. These are all things we should pay attention to.
Please subscribe and follow New York Daddy Investment.